Friends, this is the basic concept of accounting. First, before going to the accounting, we should know whether the accounting was exist before Luca Pacioli. Yes, accounting was exist in the Chanakya times, in the Vedic times, but that was the method of accounting at that time, during Vedic time, during Chanakya time, was different. They were generally based on the cash basis of accounting. Double entry system of accounting was indeed started by Luca Pacioli, and he is called the modern father of accounting. So generally we have got an idea what is exactly accounting. The concept of accounting comes from the events and a transaction. All the events are not transaction. Suppose you are purchasing a pen by paying ₹10, it is a transaction. क्यों? As it is a transaction because money is going out. Therefore, it is a transaction, there is a exchange of money and exchange of goods. So exchange of goods by monetary terms is your transaction. Suppose you are going to a movie with your friend. It is not a transaction, but it is an event. So those events which results in monetary transaction, monetary terms is called transaction. So generally it is called all the events are not transaction, but all transactions are events. So all the events, what is happening in the society, in the business, if it results in an exchange of money, exchange of goods by monetary terms, then it is called a transaction. And accounting generally clears your idea on transaction. It identifies the transaction, measure them in monetary terms. First, the job of the accounting is to identify what are the transactions here. Then this transaction is expressed in monetary terms. Maybe it may be rupee, it may be dollar, or etc., CAD, etc. Then all these transactions are recorded, and suppose in a year there are salary for 12 times, wages for 12 times, rent for 15 times, traveling for 100 times. So salary is put in one place, that is called classifying and summarizing. Rent is put in one place so that we can know in a given period how much is the rent, how much is the salary, how much is the wages. And based on our objective, we analyze this transaction to find out whether there is any control is necessary or not necessary. and the result of these financial transactions are communicated to the users of financial statements. The objective of any accounting is to prepare at finally the financial statement, getting the result and communicating that result to the users of financial statement. So, accounting is identifying, measuring, recording, classifying, summarizing, interpreting, and communicating informations to the users. So, friends, who are the generally users of financial statement? The owner. Because owners have invested their money. Shareholder. In case of proprietary firm, we can call owner. In case of partnership firm, owners are the partners. In case of company, owners are the shareholders. Investors, those who have invested money in the business, they want to know the financial information because their money has been invested. They want how much is the return they are going to get, how much is the interest they are going to get on investment. Similarly, banks, those who are giving your financial loan, etc., they are interested in financial statements. Similarly, the government, they want the information for tax purpose, for different other purposes. Similarly, the owners, the users of financial statement is the purchaser of the business. If somebody wants to, A wants to purchase the business of B, definitely A is interested to find out the financial position of B's business so that he can fix the price. Therefore, the purchaser of the business is very much interested in financial statements. Then let us come to what are the three basics of accounting. As you know, the golden rule of accounting. Now this golden rule has been substituted with the modern rules of accounting, and that we shall discuss later on. So let us find out this golden rule of accounting. It was the brainchild of Luca Pacioli, the father of modern accounting. He has clearly given the rules of debit and credit. Every debit has a corresponding credit. So rule 1, this is applicable to real account, and debit what comes in and credit what goes out. All these things you are seeing like assets, plant, machinery, furniture, all are real accounts. And when we shall do the journal entry, concept of journal entry, at that time we shall know much more about the real account, personal account and nominal account. Rule 2, debit the receiver, credit the giver. This is personal account. In personal account, the example is debtor, customer, supplier, creditor. So, rule 3, debit expenses and losses, credit incomes and gain. This is applicable to nominal account, all expenses, all losses, all income and gain. Rent is a expense, salary is a expense, interest on investment is a income. So, debit expenses, credit income and gain. Similarly, what are the four types of accounting? This is a question, and this is corporate accounting. Corporate accounting refers to the accounting of companies, corporate body. Forensic accounting, it is a new concept that is going into depth of the transaction. This is forensic accounting. This forensic accounting can bring out the truth behind the transaction, behind the accounts. Then public accounting, this is applicable to government organization, and government accounting also is there. Some different type of formats are used by the government body. Who is the father of accounting? As you know, Luca Pacioli. He is the father of modern accounting. He was born in 1946 or 47. As you know, there is no real either in 46 or 47 that different persons, they come out with different ideas. But he died on 19th June 1517. So he is called the father of modern accounting. You can see the picture of this legendary personality. And I should tell you, he's come out with the basics of that dual aspect of accounting, but nobody accepted it since till 400 years gone. So from the concept, 400 years people of the world, they do not understand what this man has told. But after that, in early 19th century, 18th, 19th century, people think what was the idea of Luca Pacioli, and it becomes a big shape. Now what we are exactly doing in accounts, all these are based on dual concept of accounting. So let us come to what are the 5 basic accounting principles. As you know, it is a matching principles, historical cost principle, conservatism, substance over form. So these are the basic principles of accounting. What is Tally? It is a modern accounting software, and it includes Tally Prime. Two main types of accounting are cash basis of accounting and accrual method of accounting. In case of cash basis, we only take into account what is cash received and what is cash going out. All receipts are considered, all payments are considered. Outstanding and prepaid are not considered. Suppose you have paid the rent for 11 months, 1 month is not paid. In cash basis, 11th month of rent is taken as expenditure. But in accrual method, 11 month paid, 1 month is outstanding, that is added, so that we take into account the 12 months of rent as expenditure. Therefore, the outstanding and prepaid. Prepaid means advance, so outstanding is added and advance is less in case of your accrual method of accounting. What is accounting process? That is identifying the transaction. First, when the account starts, it starts with a financial transaction. The transaction generates a voucher, and voucher is the first step accounting start. It is the source document on which the total pyramid of accounting is resting. Therefore, the first idea is the voucher. From the voucher, a voucher is the proof of a business transaction. From voucher, a journal is prepared, and journal shows you the respective account, how it is debited, how it is credited. Then comes the ledger. The journals are posted into the ledger. Suppose the salary of 12 months are posted in a single account called salary account in the ledger. The rent of 12 months are posted in a single account called rent account in the ledger. So, ledger is a summarized form of transaction. It is the most important form of transaction. Then at the end of the year, some items are left. For these, some adjustment entries have to be passed. If a rectification is necessary, we also pass a rectification entry in the form of adjustment entries. Then comes after preparing all these things, it comes the trial balance. Trial balance is a balance of debit and credit. If the trial balance agreed, then it is generally, we take the concept that accounts are arithmetically correct, but it is not the complete proof. If the trial balance does not agree, then generally the accountant search for the mismatch. Then after trial balance, we are going for financial statements like statement of profit or loss, which shows how much profit or loss we incurred in a particular period. And what is the financial position? The financial position is given by the balance sheet of the concern. Then the trial balance, all the balances of trial balance are transferred to the next year by closing entry. Then comes what are the types of accounting? Managerial accounting is a developed concept. Cost accounting, inventory accounting is all related to the stock, how recording of stock, issue of stock, internal auditing, external auditing, tax accounting, public accounting, financial accounting. Then who is the first accountant? Probably in the modern accounting, Luca Pacioli was the first accountant who came with the double entry system in 1494. And from 1494 to 1900, more than 400 years, nobody understand what he had written. And after that, everybody worshipped him, and everybody thought he had come out with a miracle thing on accounting. What is accounting cycle? Accounting cycle shows you the process of accepting, recording, sorting, writing transaction during a particular period. This is accounting cycle. Then what is journal? Journal is a first step of recording financial transaction. I had told you the voucher is a document, source document, and from the source document the journal is prepared. Suppose somebody purchase a pen, then pen account debited to cash. Pen is coming to you, pen is an expenditure, therefore it is debit. and cash is going out. Credit what goes out? Cash is going out from your pocket, therefore cash is credit. All these things we shall discuss regarding journal entry. Then what is ledger? Ledger is a summarized form of account. This ledger is called the final entry, a book of final entry. It is the most important part of the accounting because all the transactions of debit and credit are recorded in the ledger. Then why ledger is important? It is the king of all accounts. It is a summarized form. It will give you the information. Suppose you have paid salary for 12 months, ledger will give you how much salary has been paid in total, how much rent has been paid in total, what is the sales total figure. So summarized form of information is always given by the ledger. Therefore, the ledger is the very important form of accounting. Friends, if you like the video, please subscribe and offer your comments. Thank you for the next class.